Okay, so look, Costco is like one of the greatest retail stories of all time. This is like an amazing, amazing business. So let's talk about some of the numbers. So they generate 275 billion in revenue per year. Okay, that's the retail price, basically how much we all go in the store buy stuff. If you aggregated all that, it's going to be 275 billion per year. At least this is in 2025. This means that for every square foot of space in that store, it's $1,800 of revenue per square foot. Okay, so if you took all the Costco stores, saw how much floor space there is, divided by the revenue, it's quite a lot. $1,800 per square foot. Okay, if you compare this, just to give you a comparison, Walmart and Target are 400 to 600 a foot. And the higher this number, it's kind of like, it has to do with this velocity thing I'm talking about. You can see that this luxury retailer, Tiffany, is higher, but they're selling jewelry, right? So you would expect that that store is going to generate, it's a small store, smaller footprint, but they're selling really high priced items. So this is not surprising that per square foot, they're making 3,000 bucks a foot. Okay, because they're selling really high priced items that don't need a lot of space to store. Okay, Lululemon is selling like high end apparel, right? They also have really small stores that sell expensive stuff. So the fact that Costco is selling kind of like everyday food items and stuff, and they're generating the same revenue per square foot or more than Lululemon is pretty amazing. Okay, it's an extremely productive use of retail space. Um, they also, another way to look at this is per Costco employee, there's $750,000 of revenue. So each person working at Costco, they're they're contributing $750,000 of revenue to that business. And of course, this doesn't include all the overhead, and each employee has a salary. So it's not just like pure profit, but that's very productive. Each person that they have there is contributing a lot to the business, okay, on average. So Costco, they have a company-wide policy where their gross margin is limited to 15%. So if they bought something for a dollar, the most they're going to sell it for is $1.15. Okay, this is for Kirkland items, and the highest they're going to sell for non-Kirkland items is $1.14. They're never going to charge a gross margin more than that. Now, they could increase their margins like just by raising some stuff by like 50 cents, it's going to increase the margin by a lot. Why do you think they keep this as a policy? What benefit does that have to their business? Yes, that's true, but you could argue that the consumer is not sensitive to like a 15 or 20 or 50-cent increase in the price. There's another subtle reason. Yeah, loyalty. If you as a customer know that the price you're getting in Costco is the lowest, you're never going to go anywhere else. Okay, you're not going to price shop, you're not going to whatever. You're going to just go there to buy all your stuff. And so they're trying to capture all the spend from their customers. So that loyalty that they get from making sure that they're not skimming their customer, the customers kind of know this. They know that they're not going to get their stuff cheaper from anywhere else. And so they're just going to go to Costco and shop. Okay. So it's a very intentional policy that they have. Okay. This is a key, like, kind of accounting business model thing that I think people don't really understand, or like the common person doesn't know about. But now you guys are all, financial analysts, accountants in the making. So I think it's kind of cool and actually quite amazing. Okay, so uh, the Costco model is that they're just gonna buy stuff in bulk and they just kind of dump it on the floor. Okay, there's no nice displays, and it's not a very like aesthetic place. Like if you go to like Lululemon, they got like probably injecting all the stuff in the air to make it smell good, and they're trying to get you in the buying mood in a much more like salesy way at these high end retailers. Costco just puts the stuff out there, has a price, and you just like go in there and shop. And you actually just take it off the pallet. They're not even like putting it on shelves in a very like fancy way, right? They're just kind of putting stuff out there. You just go and buy it. Okay. So it's very easy for them to do that. You don't need a bunch of people to stock the shelves. Like if you guys have gone to Trader Joe's, you see that there's a bunch of people, they have the boxes, they're like putting it into the shelves. That takes a ton of labor. Okay. So Costco, they save all that labor by just putting the pallets like kind of directly on the sales floor. Okay. They also don't need a lot of warehouse space because like a Trader Joe's is such a small retail space that they have these large places where they aggregate all their inventory. And that's like a separate real estate investment that they have. And then from that distribution center, they send the goods to all the stores. Costco doesn't really do that. The stuff just comes directly to the store. Okay. So they're saving on that. So the fact that they can go from buying the inventory from their vendors directly to the floor, and they sell the merchandise in less than a month. Okay, that's kind of the turnaround time. The average time it takes from the time they buy it to the time they sell it is less than a month. And what that means is that usually when they buy the goods, they don't have to pay the vendor for 30 days. Okay, so what they're doing is that they're buying for $1. They're not giving the cash yet. They're selling for 2 before they even have to pay the vendor. So they basically don't have to finance that inventory purchase. They don't pay. They're selling it before they have to pay for it. Okay, so this is a negative cash cycle. This is a huge advantage. They don't have to go to a bank and be like, "Hey, I need to borrow $100 million to buy inventory." Um, they're essentially selling the thing before they have to pay for it. Okay, and this is like really, really rare and very valuable because you don't have to worry about having what we call working capital. Okay, it's kind of like the airlines where the customer pays up front and you can use that cash to pay for the plane and the whatever the salaries and stuff. Okay, so usually retailers don't have this. They have to figure out a way to finance the inventory. Walmart is another one that does this. They do it through a much more like sleazy or like cutthroat way. Okay, they just tell their vendors typically if they require 30 days, Walmart's like, we're not going to pay you for 60 days. Screw you guys. You have to figure out how to pay your workers and stuff. Okay, so they're more cutthroat with their vendors. Costco does not have to be because they sell the goods so fast. So yeah, I think you'll see this a little better when we talk about the different transactions for buying and selling inventory. But yeah, Costco is like, they have a ton of advantages. Customer loyalty, they have this retail model that's so capital efficient, and they just have a culture too. Like honestly, the culture that they built uh, from the beginning. They just like, they pay their employees really well. Um, and whatever they're doing is working. Okay. It's like, it's a business that's very hard to beat and to disrupt.